thank you very much for joining a Cryptocurry live chat. We're joined here by Ben Sebley, who's partner at BCB Group. So very timely, talking about the challenges of banking crypto companies and the role that they've played in providing banking services to a lot of the majority of the crypto companies out there. And we'll be also talking about the context of banking for crypto on a greater whole. So thank you, Ben, very much for joining. Also joined by Ryan Hamley, who's at CoinFirm, been in the crypto space for a long time. We'll be helping to ask all the tough questions. We try and make these Cryptocurry live chats as interactive as possible.
It's probably worth just, I guess, kind of introducing me and then sort of explaining who BCB Group is, and very much reiterating this is not a pitch, but so I kind of came into crypto from banking sort of late 2017, early 2018. And then was fortunate enough to sort of be on the team of the company that I helped set up and sort of invest in BCB Group, and then come over across more full-time sort of late 2019. And really kind of, for those that don't know, so BCB Group is a sort of business banking partner that purely focuses on the crypto space. So we are dual regulated. We're regulated here in the UK, we're regulated in Switzerland, and really as a company, we kind of do three things. So the first thing we do is trading, and that really harks back to our roots, and trading split up into two functions. So one is crypto trading and one is FX trading. So our big kind of USPs there, we focus on sort of as tight rates as we can and really speed of settlement. The second thing that we do is what we're probably known for now, which is sort of business banking. So we give bank accounts to crypto firms in 29 different currencies. So we're lucky enough now that, because we've been in the space long enough, that we've got a really, really lovely roster of clients, some of the biggest names in crypto. And that's allowed us to really roll out products that you might have seen recently, like the likes of Blink, which just basically is our version of what Silvergate and Signature have done with Signet and Sen, but here in Europe. And really the third thing we do is what we call the custody marketplace, which is something kind of that's fairly new. And effectively, we give the ability to have crypto accounts next to your fiat accounts, and potentially even sort of link our systems into some of the custodians that we bank. So that's something we're looking at growing. But that's really sort of us in a nutshell. And I guess we're here to sort of talk about the nightmare that is banking for crypto companies. So I'll probably just start and just say a little bit about sort of what banking looks like as if you're a crypto firm. So really the toughest challenge, I guess, for even established crypto firms, but also especially for new firms that kind of start in the digital asset space, or even traditional firms that want to break in, is whatever banking you have, if you have banking, is probably not going to be compatible with your operations inside the digital asset space. So what does that mean? That basically means you need to get a new crypto-friendly bank. Or if you haven't got banking, you need to get a bank account, because you obviously need to receive, say, your startup funds, or you need to pay your salaries. Currently, the US dollar market for banking is sort of monopolized by 2 to 3 sort of big banks who are great. Signature, Silvergate have been around a long time. They do great things. There's also Kingdom Trust as well. In Europe, it's very much more of a hodgepodge. And what we've seen, which is really, really weird since we've started, is that banking has actually got harder for crypto companies rather than easier. What we've seen is sort of the big banks, sort of, especially in the UK, like Barclays and NatWest, for instance, they tried very quietly to dabble in crypto, and they very quickly realized kind of the juice wasn't worth the squeeze. And we've seen that sort of carry on throughout Europe. We've seen it in Asia as well. And now you're getting less and less banks sort of willing to dip their toes in what they see as an ultra high risk space. So that's really where we came in. And we just wanted to solve the key problems that we thought, affected pretty much everyone. Can I get a bank account? Okay, we've solved that. The next big problem was getting cheap access to things like FX. It's something that if you own a biscuit company, you can get really cheap FX, but if you're a crypto company, it's almost impossible. So we solved that. And then we kind of established this really, really lovely company that straddled both sort of traditional banking and the digital asset space. And now that's given us loads of opportunities to sort of do some other cool things. So that's my rant over. Very happy to sort of chat about whatever anyone wants now.
Very good. So, I mean, one of the things, Ben, I think is worth addressing is, why is this even a thing? I mean, we're, since the Bitcoin white paper, we're 10 years down the line. We have various different AML tools. We have chain analysis to be able to really identify where fraudulent things have sort of gone on previously. We have lawyers in this space who have made incredible amounts of money. We see a lot of them on the call right now, from being able to help people to issue in various different jurisdictions. We've seen regulation within Gibraltar under a DLT license. We've seen it in Malta. We've seen it in Singapore. Yet the banks haven't really followed suit. There's kind of you guys and a handful of others, and even a few of those are kind of lopping off as we speak. I mean, what would you say the core reasons behind some of these major banks really not supporting any of these crypto enterprises in current state?
Yeah, I mean, it's a good question. So I think there's a few parts to that. Firstly, let's sort of remember that it's still a really small space. If you look at the market itself, it sort of trades, on a good day like the biggest stock in the FTSE. And the infrastructure now is sort of really only starting to get there to a point where sort of big traditional institutions can come in, learn about the space, and then sort of comfortably go, okay, cool, there's enough regulatory clarity, there's enough sort of infrastructure to back up what we do. We just need to now learn about it and then enact it. And I think that sort of leads nicely into the next issue. It's learning about it. It's a tricky space. You need to sort of have an interest in it, understand it, and then even be inside the space, know the people, have a network to see the opportunities. If we look at what's happened, even in the last 2 years, we've had sort of crypto winter, we've had massive changes in infrastructure, massive changes globally in regulation. And unless you sort of follow that, it's a bit of a nightmare. And I sort of take a really good example of that. If you track sort of the investment banks' dedicated crypto teams, the investment banks will look at this opportunity, they hired teams, and very few of them actually did anything with it. The best things that a lot of them did with it were, say, Goldman Sachs trying out kind of deliverable futures. Then we had sort of kind of some investment via VC arms of the banks, but there wasn't really anything done. And that just shows you that, the space probably moves too quickly. It's too much of a burden to learn about for sort of more traditional guys to sort of realize the opportunity. But now I think we're definitely coming to a point where the infrastructure's there, the regulatory clarity's there. People are hearing about things like DeFi. People are hearing things about kind of yields you can make. Especially with the sort of global economic backdrop, it's now starting to interest people, but it's still not there. So really, you've got those huge barriers to entry. You've got that kind of educational barrier. Then you've got the fact that you've got to completely change your systems to work, to store crypto, to potentially do bits and pieces like that. So it's definitely not insignificant, but we are seeing the change, certainly in the last 6 to 8 months, especially.
Very good. And I mean, typically when a company is sort of coming to you, I mean, I imagine there's a number of requirements that will be needed of them if they've been involved in the crypto industry, in terms of, even if you will take them on, maybe you could take us through what that looks like in terms of an onboarding process. So what these guys would need to have in place. Let's say let's do a theoretical one. I've raised money via an ICO in 2017. But I was one of the more cautious guys and worked with someone like Ryan Hanley. And I did things like KYC and AML, and I got a good lawyer, and I did it in a jurisdiction with a clear framework. And all of my big private investors had source of funds checks done on them. And I've got all of this Tether or Bitcoin sitting in numerous different multi-sig wallets. And I need to do things like, pay my rent and pay things in fiat currency, like staff wages and so on. And I can't really use the traditional kind of banking systems which are out there. Others are charging me very, very large amounts if I do use them, or I have to go to some far out jurisdictions which I don't really trust. what are you kind of looking for when you're sort of dealing with a client like that who's maybe gone through that process 2-3 years ago?
And to add on to that, what are the absolute things that you can't deal with?
Yeah, sure. So I have to be really careful here because my compliance team's going to beat me up if I get any of this wrong. But
Me too.
yeah. So it's what we'd say is, to be able to do what we do in the space, our sort of compliance and legal teams are sort of phenomenal, and that's been a really core base of how we've set up. Now, we actually only require some fairly normal kind of KYC, AML type onboarding stuff for the process. Everything you would normally need, company docs to prove you exist, who are the ultimate owners, etc. Like, simple things. However, there are hard lines. What's difficult for us is if you raise money via an ICO, it's pretty much agreed.
Full stop.
Yeah, that's difficult, and it's difficult because any partners or banking partners that they've drawn that sort of red line in the sand. Now, it's pretty much agreed. If you've raised via an ICO, then your source of funds is probably going to be invalid until you can investigate and prove that you've got KYC ML on everyone. It's not necessarily a red line, but it makes things really tricky. A big thing for us, I would say, anecdotally, is, well, sort of fun for our compliance team is that it's basically like a murder mystery, because all these crypto companies, they're so global. They've got like multiple different entities. They've had to be really creative with how they structure themselves so that they fell on the right side of regulation. And where we see an issue now is those that sort of offshored themselves deliberately but didn't have a good reason for being offshore. And that's where we see kind of the big regulatory hurdle now. So it's not... Sorry.
Would this be kind of a scenario where, let's say, US founders offshored in the BVI?
Yeah, so BVI is not a hard no, but we really need to look into why you're in the BVI, what you do, and we need to be really, really clear about that. Again, there's very few very hard no's, but each company is so different. We need to then do an enhanced set of kind of investigation around it. And look, I'm not compliance, but this is anecdotally what we see as sort of the big issue at the moment. But having said that, most companies in crypto, because everyone knows each other, they all kind of hoard towards the same thing. At the minute, it's where can I get regulated easiest? A lot of companies go to Estonia, incorporate in Estonia, because they know they can get licensed to show that they're just a normal company. They're legitimate and they run things to a certain standard. And we see big trends. People will go to Malta, then it was Estonia, and then it might be somewhere else, where actually sort of the best thing you can do is just try now and get as licensed as you can in the place that you operate most of your business out of. There's only been a few companies that we've really struggled to onboard. We have turned quite a few away, but actually most we will really make the effort to get you on board and get you, a bank account.
Going back to 2017, do you think this was clear to any of those companies that you've mentioned did go offshore or did do ICOs, or were they just not even thinking about that at the time?
No, it wasn't. I mean, that was the nightmare, because it really forced people into the shadows. Like, if people can't get banking, they have to get really creative with how they, pay their staff, do things like that. And it almost delegitimized the industry because there was no clarity. We didn't have any kind of clarity on regulation, or we certainly had a lot less. Banks were unsure of their crypto position. They were still sort of kind of going, oh, do we, don't we? So basically people were just going where they could. And that is part of the reason you've got some funky structures now in companies that we onboard. But, because we're specializing in that, we sort of understand it. So we work really closely with the companies to sort of understand why. We get it. We've seen it before. We know it's, say, not a risk, but it might look, say, more risky to people who don't understand crypto and crypto companies and their problems and stuff.
So in terms of sort of regulatory jurisdictions, we almost, from token market side, we sort of saw this, as you say, loop of people going to different jurisdictions as kind of the narrative change. So kind of pre-DAO ruling, no one really did KYC AML because they basically said it's utility. Why would I? I'm basically admitting this would be a security if I do KYC AML. It has utility within this system. When you're receiving hundreds of thousands, millions of dollars, maybe you need to do a little bit. But we kind of saw this transition from kind of Switzerland, and then we saw Gibraltar, then we saw Malta, then we kind of saw Singapore come into the fray. And it almost feels like we've come back round to Switzerland in some way or form, and maybe Germany as well, in terms of the sort of the jurisdictions which are maybe being a little bit clearer. I mean, from your viewpoint, what's looking good at the moment in terms of jurisdictional clarity in order for you to be able to bank some of these companies who maybe are doing, token issuances or crypto-related business sort of from 2020 onwards? So learning the lessons of the past and now building something from here on out.
So look, I think, being really honest, if you are in a more Western jurisdiction that has some kind of regulatory clarity, we have that, say, in the UK, we certainly have that in Switzerland, and we have sort of some in Germany. If you're in, seen as an upstanding country, and that's where you're incorporated, then pursue any regulation that you need there. And that really goes down well. Sort of people who maybe don't incorporate in those jurisdictions can then try and, license, like we saw kind of the move towards Estonia. You might be, say, a Bulgarian company, but that if you incorporate and license in Estonia, you have a better chance of sort of being well regarded, respected. It's a known quantity. There's no definitive answer. I would just say, look, wherever you are, make sure you operate and do what you do well to the standard that would be expected of, say, a financial firm that deals with money and people, and incorporate in as kind of decent a jurisdiction as you can. And really, like, there's no kind of hard and fast rule. It's sort of every company is completely different. And actually, a lot of the kind of older companies, because of all the legacy issues, they've got this kind of legacy stuff and a mismatch. So you sort of have to deal with that anyway. But yeah, there's no hard and fast rule. Just kind of do what you do it well, especially if you're retail focused. That's obviously the biggie.
Interesting question just come through from Hugo a little bit on that. If ICOs hypothetically were now back in fashion and were happening still, or again, if one were to do an ICO now, would one be able to do an ICO if one had all the correct KYC and AML in place ahead of that? Do you know where that would stand? It's a bit of a hypothetical question here from Hugo, but it's one that I've heard in various forms from lots of people. So.
Yeah, again, so, I mean, I'm not a legal person, but for my understanding with the ICOs and stuff is that different countries will have different rules surrounding things like crowdfunding. And crypto companies are global, like exchanges are global, So you have to do something that satisfies pretty much as many different countries and their sort of regulatory position as possible. So to do that for something like an ICO, which is effectively retail facing, so, this is what the regulators are worried about. They're worried about Mrs. Miggins getting kind of scammed out of £1,000. They're not necessarily worried about kind of professional investors who would have some kind of like comfort operating in certain markets. So to find that sort of balance when you're retail facing, I don't think there's that regulatory clarity. So I couldn't see a way it would necessarily come back unless we had a bit more on the regulation side from, say, a leading jurisdiction like the US, for instance.
Yeah, I think we can rule the US having any clarity on that ICO issue for some time. The SEC is more, let's say, reactive rather than putting forward some sort of protocol to be able to kind of follow. They'd rather come in a year and a half, 2 years later and tell you you've done wrong and you've issued a security. Very interesting, much like e-cigarettes. It's quite an interesting one in the US. They didn't regulate, and now they're having a huge amount of problems off the back of these people getting bubble lungs and what have you, and having massive amounts of nicotine. Whereas in Europe, we actually took a stance of saying, we're going to regulate this, we're going to limit this, and we're going to keep a kind of a quite smart protocol on how people can issue these things. And it worked out a hell of a lot better. I've got a game for you, Ben, because this is one that always used to come up and it's called Red Flag Bingo. So, because obviously there's a number of different things that, you know, would typically raise a red flag on a crypto orientated company based on different jurisdictions and what you've done previously. Welcome people to come into the questions of the Q&A to throw some of these at Ben as well. But typically I imagine you've got not several, but maybe tens of different things that you're looking for in terms of an application. So maybe give us a risk score of, I don't know, 1 to 10 on things that are clearly going to get your compliance officers in a bit of a tiz if you're a crypto company.
Yeah, got it.
How about we start with, how about if I use crypto in my company name? Where does that go on the scale?
No, that's fine. And you should see when we organise our kind of like client folders by letter, B and C is like 40% of our clients. It's insane, but no, crypto's fine. Like we're well past that, so we're okay.
When did that start being okay? Because I remember distinctly when having the word crypto in something wasn't fine. When did that change?
It wasn't. So this is the thing. So for people that are comfortable with crypto, it's not a problem. It's when you start kind of, it was for those that tried to use the sort of traditional banks and didn't tell the traditional banks what they were doing in the digital asset space. So it then flagged up. So, you know, the bank, you know, had an account with this client who they thought they were doing kind of Forex trading. All of a sudden you start seeing kind of crypto X, bit Y. They just put an instant pause on that account because they weren't a known crypto trader. So, you know, when you have kind of dedicated people like us who just do crypto all day, every day, you know, we expect that to happen. It's not an issue. It's not a red flag at all. And I would say, you know, from, you know, there's probably a few too many cryptos and bits in people's names. So maybe that was always my one reservation about the space. It wasn't necessarily that professional. So maybe get a bit more creative with the names.
Other than curry gloves.
Yeah, at least a curry in there. Nice.
No problem. All right, I've got another one for you. So in the main description, if someone says the term banking the unbanked, how high up on the 1 to 10 scale for being flagged by compliance would that be?
That's like a big flare going off in a very dark night.
That was a 10 for me when I was ICOs, for sure.
Yeah, exactly. You know what's actually the biggest red flag for me is if I'm speaking to a company and they can't explain what they do clearly. That's the biggest red flag. You know, I'm just saying, you know, and you keep asking like, yeah, but what do you do? And that's always going to be the kind of big red flag. If they can't clearly convey what it is they do, how they do it. Well, that's the main thing at the minute.
It's a little bit harsh. I mean, you know, Snapchat had a $4 billion valuation. And if you ask them the question, how do you make money? They couldn't answer you. So, you know, I think it's a little bit unfair if we're, you know, comparing it to the more traditional world. What else do we commonly see from crypto companies? Okay, it's not really a red flag, but DeFi. So this concept of...
Or having a name of a food in your name of your DeFi company.
There we go, yeah. good one, Erica.
Yeah. That's fascinating. I mean, that's really, that hasn't really kind of come to us yet. We haven't seen, I mean, DeFi we're interested in for some of our products and things that we're sort of kind of looking at launching, but we have yet to sort of been approached by the swathe of DeFi companies people think are out there. Again, they'll be able to explain it, but once compliance has a look, they'll always be able to uncover if you start wanting to sushi swap stuff and can't explain why you want to do it. You know, it's all part of the same thing, whether it's crypto or not.
Well, why is it that they haven't been going to? Is it just that they're just not looking at banking yet because they're so happy that they've suddenly raised huge amounts of money in crypto?
It's probably very simply because a lot of them, I think, are US based, raised in US dollar, and will bank US dollar with some of the main banks over there, or are part or are owned by another one of our clients.
On that note, do you see the whole DeFi bubble as being ICO's take two? or have you got a different viewpoint on it?
I was worried about it. Ultimately, if you raise money legitimately, you know, via VC, then it's absolutely fine. We've got an interest in DeFi for some products we're looking at. However, it's so early, and there was so much noise that we're quite cautious of it. And also, let's face it, there's no point being on whatever the latest fad or trend is. We just kind of go where we know there are problems. And the sort of the problems are the more simple things, like making sure everyone's got a bank account that works, making sure that it's as cheap as possible, making sure that, you know, people have access to Forex, people can, you know, even just connect to your systems. Like, that's a big thing. Most big banks don't have APIs. You can't kind of link in. So exchanges can't set up and, you know, do their wonderful things, and other kind of crypto firms. So it's really just solving the simplest things, but solving them well, and then building from there where you see opportunity and client demand. And that's always been sort of how we've done things. When the clients kind of start twisting our arms, we know we sort of need to kind of go off in that direction, as opposed to just hearing everyone's looking at DeFi and sort of kind of jumping in.
So what would you say is your kind of percentage acceptance rate based on people who are applying for bank accounts with BCB Group?
Oh, it's really, really high. I mean, once you get to, we rarely turn people away, but having said that, a lot is done at sort of the sales front end. The sales team, they're all, and deliberately so, they're all kind of brought up to speed constantly on the latest compliance issues and kind of what we accept legally. So they do a lot of that filtering right at the front end. So we're not wasting sort of the client's time, we're not wasting our time. But often, I mean, like you'd expect, it's just normal companies that are really legitimate that just need a bank account. So really, our turn away rate is really low. It's only when we uncover something that people have tried to hide, or something really is dodgy or a red flag, that we have to sort of say no. And sometimes it can just be this is a no for now. Do this, that, and the other, and then we can look at the application again.
So out of interest, for those companies that are no's or no's for now, some of them, okay, presumably will comply and will go back to you and get banked. What do the others tend to do? Have you seen any trends there?
Yeah, so they'll go away and then they'll come back and try again, but maybe not have changed anything. It's a shame. Like, a lot of people will, it's like anything, especially in the kind of smaller companies like startup style. You know, they're small teams, they've maybe raised a bit of cash, they're trying to do 1,000,001 things, they try and sort out banking, then they go and do something else, and then they'll come back to you a couple of months later, and it's always the same. It's, oh, I've left it too late, please can we have banking now? Please can we have it tomorrow? And that's sort of the main trend, but it's not a bad trend. It's just, you know, startup life, isn't it?
Good question through from Rob from Apple. Have you had to shut down any accounts? And if so, what are the usual reasons?
Yes, we have. I should have really just not come on this call and just got the compliance team. You'd love them. They'd all just kind of stand there and they'd have these answers like that. And we definitely have. If we see sort of kind of, I mean, we do loads of monitoring anyway, of kind of payments, kind of holdings, you know, everything that you'd expect. If people start doing something we see as fishy, especially if they're retail facing, and we don't think that their KYC AML standards are up to scratch, even if they've passed, and we then don't think they're up to scratch, that's sort of the main cause for turning people away. Basically, people who are just trying to make a quick buck say that they'll do one thing, and then we can see that they're not doing it. That's a way to get, you know, very quickly unbanked, but it really rarely happens, to be honest. Again, like, a lot of this filtering is done like right at the front end. So we tend to, once you're in, we hardly ever lose a client.
So just a really pertinent question actually from Michael Parsons. So whilst BCB welcome crypto companies, how does BCB avoid any crypto issues with their correspondent banks? So US dollar, pounds, UTC, to whom they are connected and have to be connected to move fiat monies?
So it's a good question. I think because BCB is a regulated payments institution, you know, we don't get our payments stopped through correspondent banks. What we do see is when we have clients who have other accounts elsewhere, you know, especially in the more traditional space, correspondent banks might step in and put a pause on the payment. And in fact, we had a very big crypto name recently kind of come to us who was simply doing a transaction and wanted to send cash from point A to B from 2 legitimate accounts. And it was a UK bank that was the correspondent bank, literally getting US dollar from London to US dollar onshore to the States. And a British correspondent bank stepped in and just went, no, crypto. And we had to solve a very kind of, roundabout route to sort of sort this out for them. And this is really kind of like what we do in the space. Like the amount of times we see this kind of outside our walls, outside of our sort of ecosystem is insane. So because we've been through like the pain and the nightmare of doing this ourselves, we can then kind of come in and solve this for clients. We normally tailor solutions direct to the client, depending on what they've got set up where, and we try and sort of do it as cheaply as possible. And that's really where we sort of have our kind of edge, because we always try and solve issues that are particular to sort of crypto companies. And that's really how we started, to be honest. And I guess word got out about us.
So Dominic's also got a really pertinent question, I think worth mentioning. So we've seen Kraken in the US, a lot of fanfare around them becoming a bank out of Wyoming recently. Dominic asked, how does Kraken becoming a bank or SPDI change things? One of the reasons they cite for getting the license, they can bank crypto companies. Is there going to be an equivalent in the UK or the EU anytime soon?
So, yes. So my understanding, now we're quite close to Kraken. I know part of the story. I don't know it all. And I haven't spoken to them about it. So I definitely don't, shoot the messenger. My understanding is that they got that license so that they could kind of continue doing their sort of normal business and hold sort of e-money for their clients in a way that all exchanges do, but so that it would be sort of US compliant, which is great. And we think, that's the way you need to go. It sort of legitimizes the space further and gives them loads of options in the future. I'm not sure they want to become a bank as we would necessarily see it. They might. In terms of will that sort of kind of come to Europe? Well, this is what I mean about the sort of barriers to entry. You can't just set up a bank, certainly not in the UK. You sort of can in Europe, but it doesn't really work from what we've seen. That just does crypto. Why? Because the regulatory barriers are huge. The UK, the FCA, they won't just approve someone coming in wanting to be a crypto bank. It just won't happen. You sort of need to go through various stages, et cetera, to get where you need to be. And we've seen kind of the projects that have sort of come in, bought a banking license specifically to do crypto, not do well. And they don't do well because they don't have then the experience of operating how to be a bank, how to fit in, how to face off against kind of different pieces of infrastructure. And then you look at sort of the other side of the coin, which is the big traditional banks that want to dip their toes in crypto. A lot of them try it and they go like, the juice is not worth the squeeze here. I mean, you'll see people like JP, they'll bank Coinbase, but that's Coinbase. You won't, when Barclays tried to bank a number of crypto firms, they just went, oh, this is a pain. We don't charge enough for accounts for the headache that is sort of the high risk nightmare we don't understand about this space that no one really knows about. So they walk away, and we've seen that more and more. And it's sort of like the timing of this call is really good because, very recently in the last couple of weeks, 2 more global banks have, apparently walked away from sort of kind of crypto. So it's a really big problem. And that's why you need these sort of incumbents who really understand the space and sort of build rather than just kind of come in and want to take over and do it like that and sort of win the trust of sort of the regulators and the clients alike.
On that note, we spoke about it a little bit before. What do you see as the trends going forward for crypto companies looking towards the sort of the more traditional banks versus the newer challenger banks?
Yeah, so the trends, the trend is that banks are sort of not interested in crypto as it stands, unless you are a multi-billion-dollar crypto company, and even then it's tricky. You won't get looked at unless you deal bilaterally with the banks and you can prove that you are, the most regulated thing since sliced bread. So in terms of kind of trends, I just see more banks turning crypto companies away. I think crypto specialist banks that are regulated, like Silvergate, maybe us, doing even better. I mean, our growth has been, phenomenal in terms of sort of interest and clients and things. Where I see the really interesting trends in sort of banking for crypto companies is in things that we're sort of starting to look at, and I know a few other people are looking at, in how, as sort of a crypto bank, inverted commas, you can straddle both the traditional space and crypto space, use traditional sort of assets, and mix them with crypto assets to make everything more efficient. That's the real trend. So, stable coins is an easy one, but actually using them and then building them into your infrastructure, that's sort of the interesting trend. Generating certain yields or operational efficiency from crypto, that's interesting. How do you then face it off against traditional finance? That's an interesting trend. So I think that sort of area is what's going to grow. And in the meantime, I don't see there being any kind of interest from the big banks to suddenly jump into the space. They don't understand it. And, most people who need the bank accounts won't pay enough to cover their extra due diligence in the space. And that's what we've seen sort of anecdotally.
Okay, so one of the other things that might be worth touching on as well is that there's some pretty, I wouldn't say restrictive, but largely impactful regulations which are coming into place. So we've had things like FATFA, which in very layman's terms is where anyone who is a VASP or virtual asset service provider will eventually need to provide information around every transaction from where the wallet has gone to another wallet on another provider. So that would be things like the identification of that person, that transaction itself, to allow regulators to go in and obviously interrogate what's previously happened. You've also got the AML5 directives as well, which it seems more and more so like these VASPs and these kind of crypto companies are going to be affected by this as it comes into the space. Seems like this is going to be a really big issue for a very decentralized network of exchanges across many different jurisdictions, let alone the kind of the GDPR/safe harboring data nightmare of passing data amongst servers from Europe to the US. Do you think this is going to be a really big obstructive set of regs for the crypto industry to be able to push forward and kind of start really breaching into the mainstream and making banks even more fearful? Or do you think this is kind of an opportunity for, some of the more, let's say, pioneering crypto companies to actually fall in line with that regulation and then potentially go and supersede what's out there in the market already?
I mean, my perspective is it's all definitely a good thing. I mean, every bit of extra regulation we've seen has given a little bit more clarity, and then, crypto companies have really risen to the challenge and done it really well. It's almost like this, people are addicted to getting the next bit of regulation and the next kind of thing. And like I said, if you're a legitimate company and you do the right thing, which a lot, if not most of crypto companies certainly are, certainly over a certain size, then yeah, bring on more regulation. So long as it's not overly burdensome financially, and it's just something you can do to show people, look, we are good. This is what we do. We're part of this, and this is approved by you. I actually think it's a good thing. So I think pretty much from what we've seen with, AML5D and certainly other bits and pieces here, there and everywhere, crypto companies have really risen to the challenge, and it's helped us. And it's made us go back to traditional industry and just say, like, give us some more because we can do it, and we can do it better than you. And actually, a lot of crypto companies, I think, are better in terms of kind of how they're run, and certainly the AML and KYC standards than a lot of normal companies. For instance, in our space, we've got coin tracking. We can track the provenance of coin and things. Again, if you look into the space and understand it, because it's so technologically focused, there's a lot you can do here to improve even traditional finance and the regulation sort of thereof as well. So I think it's a really good thing. And if, there's any rubbish regulation that comes out, which sometimes there is, then people just move jurisdictions really, don't they, to get around it.
That's fair.
We've got a few questions come through about the whole security token issuance. So firstly, if the ICO red line that you mentioned applies to STOs also? And secondly, are there any good examples of security token issuance to retail that you can point out, or has a good example of an STO or security token issuance not really happened yet for you?
So STOs are great, you know, it's a security, so it has to be so above board. We're massively interested in that space, and we've got a number of partners who are deeply in it and sort of kind of live it and breathe it. The big thing about kind of security tokens is that there just isn't enough of a secondary market yet to make them really a thing. But we've seen so many projects sort of come to us that are traditional, that actually want to use, say, a crypto instrument to make, you know, an issuance they might have more efficient, more accessible, more liquid, all these things. And it's obviously regulated. It's a bit chicken and egg, because it's like, well, is there the infrastructure to hold and trade these security tokens? Well, yeah, it's coming, and if not already there, but barely. Now we need to kind of get that interest from the secondary market. And it's like anything else. You know, if traditional guys are used to holding stocks and bonds a certain way, you're going to have to really do an education piece to show them that there's this other thing that you can do with security tokens. But actually, I think kind of the biggest use case is when we just securitize real things, but have them accessible via already established sort of, you know, exchange platforms or other cryptocurrency platforms. That's when it gets really interesting. There's a few people doing that as well. So we love it. Yeah, it's more regulation, gives more clarity. I think it's the one to watch. It's just going to take a little bit more time, I think, to get there.
Chris is asking if you can say more about some of your new products that you're working on, and particularly your interest earning accounts.
Chris, I'd be delighted. Thank you. So one thing that we're very excited about is, so I'm going to jump back. I'm going to sort of go back to the problem that we tried to solve to explain this new product. So, you know, I mentioned before that, you know, if you look at most crypto volumes, they're mostly USD focused, because you've got the big banks that support USD banking for crypto. And you've also got instant fiat settlement using, you know, for those that are aware, Signet and Sen with Silvergate and Signature, which basically means that any customers that are in those banks that are crypto companies can send another customer fiat for free real time, 24/7, which means, you know, on Christmas Day at 2 in the morning, if I need to fund my exchange account with US dollars, I can. Now, there wasn't that in Europe. So we launched, the two big things we saw as problems in Europe for sort of more crypto investment were, firstly, the fact we didn't have that. So we've just recently launched and are coming out of the pilot phase of our Blink network, which basically does that for all the currencies that we cover. And secondly, was the thing that's peculiar to a couple of currencies in Europe, or a few more than a couple in Europe, is the negative rate environment. And that's such a pain, because, you know, for businesses that hold large amounts of euros and Swiss francs, for instance, you have to pay to keep them there. You know, you have to literally pay to keep your own cash, which means, why would I sit on euros unless I instantly wanted to flip out of them, and then I have to flip back to trade euros on an exchange? So this was a big problem for us. Most of our deposits are in euros, and we don't like having to pass on the balance charge for euros to our clients. So it inspired us to set up this sort of yield product. Now, our accounts aren't interest bearing anyway, even if they were, you know, it's a micro amount of interest you would get here in the UK. So we wanted to use some traditional instruments we had access to, that sort of we uniquely had access to, and also now some crypto instruments that are ultra high yield bearing, and sort of fuse them together so that basically our customers who were sat on big lumps of deposits could opt in and make that sort of cash work for them. And we do some funky things to that cash, and we'd kick back a really serious yield. And we're looking at, you know, kicking back multiple percent a year, you know, about 4 to 6% a year at the minute, which is significant. If you're sat on, money you've raised, and you want to lock up part of that, and it's 7 figures, you're talking a significant amount of money you can generate off that, which beats what most hedge funds would turn a year. So that's sort of the kind of next product we're looking at. And I was shocked when we started asking clients about it. They were desperate. They were literally biting our hand off. And they were saying, it was a big problem, and they wanted to keep more money with us, but they couldn't because of the negative rates. Yeah, so that's going to be the next thing, I think, to watch. And that's really kind of going back to the trend stuff you were talking about. That's like where crypto and traditional finance do this wonderful hug, dance, whatever you want to call it, and it sort of works out well for everyone. So that's what we're excited about.
Hugo's just raised a good point. We've talked about ICOs and we've talked about DeFi and the general ICO space, and Hugo's asking about IEOs, the initial exchange offering, which I confess I see as slightly, very much in the same boat as ICOs, and have otherwise been described as a crypto exchange's way to pump and dump cryptocurrencies. But what are your takes at BCB on IEOs and companies who have raised funds through IEOs, through initial exchange listings, according to various or their country's regulatory requirements? And
I'm not so hot on IEOs. My initial take from the little I understand about them would be it would be a bit of a no-go. It's similar, I think, to an ICO. Even if you take all the kind of KYC AML, I think that the decision you have to make... It's a
new way for the exchanges to make money.
Yeah, I think you just have to look at it. Look, how is this going to be looked at by the regulators when they eventually come around to sort of looking at this? Do we want to be caught out again? So, look, most people now raise money really legitimately. Like the amount of VC money in this space is insane. So it's not hard for good projects to raise good legitimate money. So we're always slightly wary of things that are sort of kind of look like they're just kind of a bit smash and grab. But that being said, I don't know enough about IEOs to sort of really give you a proper answer.
Just on that point and how you guys kind of manage risk. Obviously, we won't name them, but you guys obviously work with a number of exchanges within the space. And a number of those tokens at some point in time may have been funded via a launch via an ICO. And more recently, what we've seen as well on one of the larger exchanges and quite highly regulated one is some of these governance tokens from DeFi-based raises being listed instantly after a governance token has been launched. Probably without clarity from any regulator, because it's just so early and new and fresh, and bloody hell, it's complicated. So it's going to take them at least 1.5 to 2 years before they work that one out. How do you make a ruling on that? So in terms of where the kind of the buck stops, so where you guys are happy to be comfortable with exchanges who have dealt with, companies who have raised in that kind of certain manner, potentially maybe see the securities, potentially may see more regulatory hurdles come out further down the line. How do you guys sort of evaluate where your sort of safety spot is or comfort level is in terms of your involvement in providing those banking services?
Yeah, so, I mean, this is where the compliance team really earn their sort of money. And the fact they're crypto specialists means that they're aware of all these things. So every time we would onboard a large exchange, it's no mean feat. We're really forensic about it, and rightly so. And we're constantly evaluating that. So, I have complete confidence in our compliance team that they make the right calls all the time, and they're always saying no to certain things. And in fact, that's even changed behaviours for some large exchanges. Again, won't name any names, but we're glad to be a part of that and a part of that process. So going back to when I said, look, we might say no for now, this is how it would be a yes. A large part of that is picking up things like you've just mentioned, feeding it back to the exchange and just going, we need more clarity. Can you explain a bit more about this? Why you're doing it, et cetera, et cetera. So every client's completely different. But yeah, this is the exact reason that big banks don't want to get into the space, because their compliance don't have a clue about this stuff, and rightly so. If you're just normal compliance, what you need to kind of go through. If you get this kind of new company that's an exchange that, you know, a lot of them aren't necessarily regulated. You just don't have a clue. And then, you know, a lot of big banks won't charge what they need to charge to cover the expense of the compliance that they need to do and their regular monitoring. So this is sort of...
Why is that?
Because the banks make most of their money off sort of deposits because they're banks, they can lend them out and do other things. So they won't charge in the way that a lot of kind of banks that bank crypto companies charge, which is sort of, you know, having to up fees that you would never experience, certainly as an individual. So when you open your normal HSB bank account for you, Erica, like they won't charge you per month. They won't charge you to send transactions. But when you go to like business banking for these ultra high risk companies, you know, you might get monthly charges, you get kind of transaction fees, you get, in some cases, balance fees. And that's really to offset the fact that it's a massive amount of people hours to get these guys on board, integrate them, then monitor that what they're doing is right. And all for the fact that you might only get, you know, a few million of deposits when you could just go to a normal business and get a few million of deposits for just a simple onboarding. So that's sort of the kind of gray area where I think causes loads of problems for sort of banks at the minute. They haven't worked out how to sort of get into the space, understand the space, and then charge accurately for it. They just say no to high risk companies, crypto being one, and certain financial companies being another. But if you understand the company, you can sort of understand, I guess, the risk better and how to price for it.
So on one side, that the banks, they talk a great game about this kind of high risk scenario modeling. Yet this week we've had an amazing news story with the FinCEN leaks. And we've seen sometimes how lax these protocols are in terms of how the banks are following and how they're accepting money. And that in some cases, they're actually quite comfortable. I believe it's Standard Chartered, maybe for a period of 10 years or so, to be dealing with certain actors which have been highlighted by regulators and allowing them to open bank accounts and to transact. I mean, with that being quite fresh, and only a very, very small amount, I think it's, you know, 0.2% or something of the kind of the reports that got sent to FinCEN, which already shows $2 trillion worth of potentially laundered money or money that shouldn't have been banked. Do you think this is going to have wider implications on the industry? One, from sort of a banking perspective, do we think there's going to be more scrutiny in terms of what they're doing in the traditional world? And two, do you think that's going to have a ripple down effect in terms of how crypto is seen as well, either in a positive or a negative light, especially in terms of, as you mentioned earlier, being able to track the source of funds all the way through a blockchain in a much more forensic detail?
Do you think that will lead to another wave of de-risking?
Interesting.
Crypto being seen as a sort of an easy go-to.
Yeah, I mean, it's funny, isn't it? Because the FinCEN files, I mean, they're talking about these percentages, but it literally is probably tip of the iceberg. And, you know, anyone that's worked in a big bank before knows, let's face it, I work for Credit Suisse. Do we honestly think that Credit Suisse doesn't put through millions of laundered amounts? It's just whether these people get caught. Ultimately, will, you know, there be an addition to a sort of regulation around kind of AML for this FinCEN stuff? Probably. You know, our clients and sort of kind of, I know we're certainly set up for it because we're so tight on AML and source of funds and things like that. That's really kind of the hot. But we see most of our clients are all over it. They really are. And actually, again, I think it would just be one of those additional bits of regulation that would help the space do better. And people, like I said, they're set up for it. I'm sure they rise to the challenge. And we forget that sort of traditional finance is guilty of so much. And especially if you worked at a big bank, you see it all the time. And crypto, because it got branded as sort of the naughty boy on the block, it's had to really struggle to shake that reputation. And actually kind of, there's a lot of really cool things you can do in crypto to de-risk it massively. It's when traditional start picking up on that I think sort of that there'll be a better crossover, certainly on the compliance ML side, hopefully.
I think one of the great points, I'm trying to think who got quoted saying this, but I think it's one of the law enforcement agencies in the US said, we're quite happy when Bitcoin gets used because we can actually go and trace it and find out exactly who's bought it out of the system because eventually it's got to turn into fiat.
It's the DEA and government agencies. If they know Bitcoin, especially, is using a transaction, they're like, oh, fantastic! Here we go, and we just knock on the door, and then they can auction the coin off. And if you're in the States, they get to keep the funds. And so, yeah, I mean,
big stakeholder now.
Yeah. So we've got all of these things we can do, and obviously, you know, people are starting to cotton on to that, which is great because it really shrugs off that whole kind of Bitcoin all comes from the dark web, which means it's automatically dodgy, which means everyone that's ever touched it is, you know, the most evil person in the world, when you can take a £5 note out your wallet and it's probably covered with a cocaine or whatever, because it's, you know, been through the system. And that's just is what it is.
Ben, I'm conscious that we're coming to the end of an hour, and I'm super grateful to you and all of your time speaking and answering all of these questions. I'm sorry we can't be together in person in a fun chat over curry, but hopefully again maybe next year or soon. But no, thank you so much for joining, and to everyone that's asked questions. I don't know, Ryan, if you've got any last pertinent questions.
There's the one question that you always force me into at the end, Erica, which
that you always are the first one that's eager to ask.
That there needs to be asked of Ben. So Ben, seeing is it's the Crypto Curry Club, we have to ask you the most prominent question. It's, what is your favourite curry?
Oh, mate, it's got to be a madras.
What are we talking? Prawn madras here?
Well, this is where I'm really exposing myself. To my shame, I've gone vegan, so it'd have to be.
I'm vegan, Ben.
Vegan, and I've told everyone now, so I've fulfilled my duty as a good vegan. Yeah, so a boring vegetable one. But to that point, also, thanks for everyone's questions. They're really, really good questions, and hopefully we can do this over a real curry where we can say a bit more outside of a recorded Zoom link.
No, I'm impressed that you've gone vegan. That's good.
Very well.
And then thank you for joining us. Everyone, thank you very, very much for joining us